5-minute tax guides from your 5-minute tax guy. Qualified Business Income Deduction. What is the Qualified Business Income Deduction? Before beginning, I want to clarify that for purposes of this video, I will only be covering the QBI deduction as it relates to individual income tax returns. Also, I want to make it clear that this will be a simplified run-through of the QBI deduction, as there are many intricate nuances that need to be considered, and it would take 5 hours, not 5 minutes, to even scratch the surface of this new provision. The deduction is generated by a pass-through business, whether partnership, S corporation, or sole proprietor, which are pass-through entities, and is passed through to the qualifying taxpayer's individual income tax return. The Tax Cuts and Jobs Act provides businesses with a variety of changes in tax reporting starting with tax year 2018. One such change in the latest tax reform is the 20% deduction for pass-through entities' qualified business income. The qualified business income deduction starts in tax year 2018 and as of now ends after tax year 2025. Eligible taxpayers may be entitled to a deduction of up to 20% of qualified business income, known as QBI, from a domestic business operated as a sole proprietorship or through a partnership, S corporation, trust, or estate. Here's how the new qualified business income deduction works, in simple terms. Business owners can deduct up to 20% of their qualified business income, or, if lower, 20% of their taxable income net of any capital gain. This deduction is claimed on the business owner's individual return. Generally, qualified business income refers to the business profits. Qualified business income does not include salary or wages paid to the taxpayer either as W-2 wages from an S corporation or guaranteed payments from a partnership. The deduction is generally available to taxpayers whose taxable incomes fall below $315,000 for joint returns and $157,500 for other taxpayers. Deductions for taxpayers above those thresholds may be limited. To navigate Section 199A, it's helpful to break the statute into a series of steps used to calculate the QBI deduction. Step 1 is determine whether the taxpayer's trade or business is a qualified trade or business. Step 2, determine the QBI earned through each of the taxpayer's qualified trades or businesses. Step 3, apply the applicable W-2 wage and qualified property limitations to each of the taxpayer's qualified trades or businesses. Step 4, determine the taxpayer's combined QBI amount. And Step 5, apply the taxable income limitation to the taxpayer's combined QBI amount to arrive at the QBI deduction. What is a qualified trade or business? A qualified trade or business is any trade or business with 2 exceptions. Number 1, specified service trade or business, also called SSTB, which includes a trade or business involving the performance of services in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, investing and investment management, trading, dealing in certain assets, or any trade or business where the principal asset is the reputation or skill of one or more of its employees. Although an SSTB generally can't be a qualified trade or business, an exception does apply for certain small businesses. If a taxpayer's pre-QBI deduction taxable income doesn't exceed a threshold amount of $315,000 for joint filers, or $157,500 for other filers, an SSTB is treated as a qualified trade or business. And the second exception is performing services as an employee. QBI calculation. Once a taxpayer has determined that their business is a qualified trade or business, the taxpayer must then determine the QBI earned by the trade or business. QBI is the net amount of qualified items of income, gains, deductions, and losses with respect to a qualified trade or business. In simple terms, the net income of the business. To begin, the taxpayer must determine the combined qualified business income amount. Once the taxpayer has applied the W-2 wage and qualified property limitations to each of the applicable qualified trades or businesses, the taxpayer can then determine the combined QBI amount. The combined QBI amount equals the aggregate of the preliminary QBI deduction amount for each qualified trade or business, plus 20% of the taxpayer's aggregate qualified REIT dividends and qualified publicly traded partnership income. The new QBI deduction may provide a significant benefit to taxpayers who own and operate businesses through pass-through entities. However, unlike the reduction in corporate tax rates provided by the TCJA, the QBI deduction is a complex and uncertain calculation that favors certain businesses over others. This means taxpayers holding pass-through entities should carefully consider how the new deduction will apply to their particular facts and circumstances, and consult a trained and competent tax professional, like the 5-Minute Tax Guy, in the application of the deduction. Here is a useful flowchart to help you navigate through the QBI deduction. Other than that, if you have to wade through this new torture chamber that Congress and the IRS have cooked up for us, here is the only ray of hope that I can offer you. That's it for this session, and thanks for watching the video. Be sure to click the subscribe button on the next screen to keep informed on upcoming tax changes. For more great 5-minute tax guides, check out the other videos in my 5-minute tax guide video series. See the list in the description below this video.